Hello and welcome back. This is Whitney Emmanuel with Whitney Wealth Group, continuing our series on recession-resistant investing. The third option that we're going to discuss in this video are bank-insured products, also known as structured notes. They are not insured by the government like cash equivalents through the FDIC insurance. We're going up a level in risk, but it still has some guarantees that are backed by the claims paying ability of the bank. It is important to make the distinction. Who's actually backing this up? Government with treasuries, with bank insured notes is banks. Structured notes allow investors the potential to participate in market gains while protecting their principal. Upside returns are linked to the performance of an underlying asset, such as an equity, index stock, currency, commodity, exchange traded fund. So there is a group of investments that are performing that drive the performance of this note. They are intended to be held to maturity and only guarantee full return of principal at maturity. If an investor sells or redeems their investment prior to maturity, they may receive a return less than their original investment. Keep in mind, these are insured by banks and are backed by the bank in its financial health. There is less security here than with treasuries, as I mentioned before. It's not insured by the government, and there's a lot more fluctuation in value depending upon the underlying asset. These notes offer a variety of protection ranging from full or partial principal protection. One common solution that I've seen a lot lately is a market indexed principal protected note. Let's discuss a real life example. An S&P index principal protected note. The issuing bank guarantees against loss for a 2-year term, and there's a 15% cap on earnings over those 2 years. Let's say I invest $100,000. If my market value is $80,000 at the end of the 2-year term, I receive $100,000. If my market value is anywhere between $100,000 and $115,000 at the end of the 2 years, I receive that amount. If it is over $115,000, I still receive $115,000, as that is the maximum return I can receive. So this is good for clients that want some market exposure, but you don't want to risk the money in stock market investing. Because the issuing bank invests your money into a zero coupon bond. A zero coupon means that it's a 0% bond, it's not paying interest. Behind the scenes, the underlying value of your investment is tied to interest rate risk, similar to bonds. The key difference is that the bank is insuring you on the bottom side. If the bank is unable to honor the terms of this solution, you could incur a loss even if you do hold it to term. Another consideration is if you lose value, you do not walk away with a gain. If you had invested into a CD, in contrast, you would walk away with at least the guaranteed interest rate if held to term. However, if you don't want to lose out the growth potential of the market, then this could be a good option for you in turbulent markets. Next, we will be discussing insurance as a recession-resistant solution. Stay tuned.